Hi, everyone. Welcome. Let's take a few minutes or a minute or so for folks to join. Thank you all for being here. Hi, everyone. All right, just going to give it a few more seconds here. Thank you all for joining us. We'll get started in just a moment. Great. So we can kick it off. Hi, everyone. For those who don't know me, I'm Whitney Shepherd, Co-Executive Director of Majority Action. It is so wonderful to have all of you joining us here today. Thank you so much for being here. We are so excited to be able to share findings from our latest edition of Equity in the Boardroom, Majority Action's annual report that examines the 2024 proxy voting performance of the world's largest asset managers on issues related to inequality and systemic racism. Wanted to share a few housekeeping rules before we jump in. So if we can go to that slide, please. Great. So yeah, just wanted to share a few of the housekeeping guidelines that we'll be working through today. Just for folks' awareness, this webinar will be recorded and the link will be shared after. The closed captioning can be enabled if you go down to your Zoom controls toolbar and click the option to show captions. The slides and the links to the materials will be shared after the webinar, and we are utilizing the questions and answers box. The chat is disabled, but the Q&A, or I believe it is, yes. The Q&A is operational for anyone who wants to ask any questions throughout our program today. For those questions that we're not able to get to, we will do our best to follow up with you all. So great. So yes, we're here today. We'll hear mostly from our Director of Research, Divya Sundar, and primary author of Equity in the Boardroom. But I first wanted to, if we can go to the next slide, just ground us a bit as to why we're here. And, oops, excuse me one second. Great. So yeah, as we are here today, I just want to take a moment to locate where we are, why we are here, and where we can go. So as we know, we gather at a moment of immense consequence. Hard-fought civil rights, diversity, equity, and inclusion gains that have been won over generations are being dismantled with a stroke of a pen. Positions, jobs, commitments, protections that once symbolized progress toward a multiracial democracy and a more sustainable world are now under siege. And the very concept of equality that's once is codified into our law is being reframed and is at risk. We are watching in real time as critical safeguards for protected classes of people are stripped away, entire institutions, Social Security, Medicaid, VA, Department of Education, right, are placed on the chopping block. We know federal agencies are being captured, from the SEC to the FBI. I don't need to run down the full list. I think we know what's at stake. And so while our economic systems and the systems that govern us become more volatile, and misaligned capital allocation, the expansion of debt, and the looming threat and the possibility of the default that jeopardizes the future that we all deserve, we are coming together in this moment. And what's very clear to me in this moment in taking a reflection is really the danger of unchecked superiority complexes and the legacies from which those stem. Now, not only is it demeaning and like gut-punchingly irritating to be subject to these complexes, but there's also immense danger when those that cling to power and have access to power shut themselves off from diverse voices, perspective, and experiences, voices that they dismiss as beneath them or irrelevant. And the truth is we're being gaslit, bullied into believing that none of this matters, that we don't matter, that our values, the facts, our analysis, the hard truths, that none of it matters, that human rights and sustainability are not evolutionary imperatives. And this gaslighting and this bullying come at a great cost. And so we are now showing up to protect each other, to survive these times, and to transform to a better tomorrow. In this moment, I also find myself returning to a piece by Michelle Alexander from 2018 in the New York Times, titled, "We Are Not the Resistance." In that piece, she says, "Resistance is a reactive state of mind. While it can be necessary for survival and to prevent catastrophic harm, it can also tempt us to set our sights too low and to restrict our field of vision, leading us to forget our ultimate purpose and place in history." She says, "A new nation is struggling to be born, a multiracial, multi-ethnic, multi-faith, egalitarian democracy in which every voice, every life truly matters. We are not the resistance. We are the force for good progress and movement. And so I really appreciate that reframe into understanding what we are grappling against. There is a resistance to the multiracial democracy that we all know we deserve, and that is what we are up against. We are the complex thinkers who understand long-term collective implications of short-term ego-driven decisions. And so we are here to understand, because we understand that these types of decisions, and when we are faced with decisions that may feel rooted in a ego-centered rather than a collective perspective, our counterforce is humility and deep listening. When we face bullying, when we face fear tactics, that counterforce that we need is courage and bravery and power in our solidarity. As Michelle Alexander says, we are not the resistance. We are the force of progress, the vanguard of human potential, of movement, of flow, of transformation. We are the builders of what comes next. And when they try to take our tools out of our hands from what we're trying to build, when they try to shut down our sights, we have to commit to finding other pathways, other avenues for solidarity. As complex thinkers, we understand the long-term collective consequences of short-term decisions. And we refuse to be driven by this fear. We refuse to be reduced by it, and we choose courage. We refuse to be divided by apathy. We choose our connection and talking to one another. So again, we're so happy for you all to be here today. And I think we are also here because we all believe in participatory systems. We believe that those work. We believe in democracy and including shareholder democracy. We are because we know our voices matter, our votes matter, and we seek the tools and the strategies to amplify them. So it's so great to be in good company today. And I think this asks, where do we go? What is the question that lies before us? The uncomfortable truth is that throughout history, every revolution has been born from inequality. The question before us then is, what role will we play in the story that lies ahead of us? Because make no mistake, there is vast, vast opportunity for those bold enough, brave enough, and innovative enough to break free from the tunnel vision of short-term profit. For business leaders and investors who have studied enough human history to know how these moments go, the choice is clear: to cling to the power games of haves and have-nots, or to embrace the transformative potential of shared prosperity, to write a new story, one in which future generations can look back at this moment when they face their own power struggles, which they will, and they could look to us and our time right now as a case study in courage, innovation, and justice. And so what we must do, we have to ask ourselves, what are the dominant affects that we want to shape our society? Are they fear, apathy, and isolation? Or rather, are they courage, joy, and solidarity? The choices are, and we have to remember, society does not determine people. People determine society. So we know that our corporate and economic systems were built on legacies of slavery, genocide, and exploitation. Those are facts. Even if they're uncomfortable facts, they are the truth. And every generation holds the power to break those cycles. I want to be clear too, we're not going to break through it through shame or guilt or not through repression. That much is clear. All of that eventually gets displaced onto the most vulnerable. No, we have to break it by standing fully in the truth of who we are and what confronts us, by addressing our root causes and not just the symptoms. And for myself, for example, the reality is I would not be here without the legacy of American chattel slavery. That is the uncomfortable truth. And yet accepting that truth, I also recognize the immense power that it offers. I am the beauty that can be born from struggle. So when we humble ourselves, again, that humility that's needed to counter this ego before history, rather than deny it, only then is when we can truly transform our systems and ourselves. And so that's why this year you'll continue to see us referencing the Edmund Pettus Bridge. It's on the cover of this year's Equity in the Boardroom report. It serves as a reminder for the shoulders that we stand on, who were facing these moments with their own unyielding bravery, and the steps that we must continue on the path that they have carved for us. We are here to carry forward that legacy. So, and in those, as we draw our lines on those bridge, what for those who attended our end of the year, last year's celebration at the end of last year, you'll hear the co-executive director, Brian Sewell, speak about his uncle walking on that bridge during the civil rights fight. And so we really do feel that deeply here. We're carrying on that legacy. And we also want to be very mindful of what lies at the other end. There is so much immense possibility, as I spoke to before, those who are brave enough to be innovative. There is so much waiting for us. But we have to make sure that our starting line, we are not confusing our finish line with our starting line. Too often we think of things like racial equity, human rights, environmental justice as the finish line. No, that has to be our non-negotiable starting line. That's where we come in, we start our engagement, that those are non-negotiable principles and that we know that we need those within our economy. Because if we lose that line or if we put it towards the end, we risk losing everything. So we are powerful and we know it. And just as we have to set goals for our own health and our bodies to drink more water, to practice mindfulness, strengthen our health, do yoga, we also know what is best for our portfolios and our economy. And in the same way, even though we know something's good for us, there still has to be a plan to get there and actually implement those into our regimen and routine. So what are those plans and regimens that those who want to have shared prosperity doing? How will we act on the knowledge that we know? What goals do we set to engage with our asset managers? What information are we using in those engagements to demand accountability? Are we updating our own policies and educating ourselves on systemic risks and opportunities and talking along a diverse set of stakeholders? Those are the kinds of questions that we want to continue to ask ourselves in these moments. It's because when we know our line, when we know what we're exercising, we become unstoppable and we can resist bullying, gaslighting, fear mongering, and misinformation and disinformation designed to entrench us in injustice and in a stagnant place. So today, as we walk through Equity in the Boardroom, I invite you to see it not just as a report, but we want you to see it as a call to action, a continued call to action, a call for solidarity, a roadmap for investors willing to stand on the right side of history. Because the future is not a distant reality, it is the sum of the decisions we make right now. And so again, we are so glad that you made the decision to be here today. We're excited to continue to walk ahead on the road ahead with you all, and hope that you will continue to engage with us, strategize, and collaborate with us to build a better tomorrow. And with that, I am so pleased to hand it off to our amazing Director of Research and primary author of Equity in the Boardroom, Divya Sundar, who will help us walk through the key findings and some of the context of the report as well. Thanks so much. Handing over to you, Divya.
Hi, everyone. It's so great to be here with all of you today. Radhika, can we go to the next slide? Yeah, so my name is Divya Sundar. I am the research director here at Majority Action. Forgive me, I am getting over a very prolonged cough, and so I'm still getting over it, so I might be coughing throughout this presentation. So forgive me in advance for that. But yeah, I'm going to walk us through this year's Equity in the Boardroom. You'll see that this year's Equity in the Boardroom is a little bit different than years past, both in terms of some of the things that we focus on. We this year look at public pension plans. We look at particular types of funds, sustainable funds. We also kind of broaden our frame to look at not just systemic racism, but inequality more broadly. And we think that this particular moment just demands that kind of more sweeping and comprehensive frame. So just in terms of what we're going to do today, I'm going to walk you through sort of our introduction and context, tell you a little bit about what the scope of Equity in the Boardroom is like, and then I'll walk you through each of the three sections of our report. And then I'll quickly talk through our recommendations and then hand it back over to Whitney to facilitate the Q&A. Next slide, please. Okay, so as I said, this year, Equity in the Boardroom is kind of taking a much broader frame. And part of that is because increasingly, under the leadership of organizations like the Investment Integration Project, Oxfam, Rights Collab, the Task Force on Inequality and Social Related Financial Disclosures, there has been a lot of movement in the investor community to identify and name inequality as a systemic risk that harms the economy and that harms capital markets. We also are increasingly seeing economists and people in the academic world look at the role that inequality plays in the economy more broadly. And that started happening after the Great Recession. There's still a lot of work, conceptual, quantitative, econometric work that needs to be done to really build this out. But leaders in the space have identified a number of ways in which inequality creates risk for investors and for everyday people and businesses. First of all, inequality constrains economic growth. It contributes to more frequent and deeper recessions. The two biggest kind of recessions in the past century, the Great Recession and the Great Depression, were both preceded by periods of extreme inequality. Inequality generates social, political, and economic instability. It leads to the rise of populism, extremism, isolationism, protectionism. I think these are all things that we're witnessing and we're living in real time. It erodes social cohesion and trust in political and economic systems. Again, I think something that feels very resonant in this particular moment. It inhibits human capital formation, which is not good for business or economic growth. Um, Crucially, it multiplies acute and long-term threats, such as COVID-19 and climate change. And finally, inequality depresses aggregate demand, which again constrains the possibilities of economic growth. And so this has led a number of people in the business community and in the investment community to name inequality as a systemic and structural risk. The Business Commission to Tackle Inequality recently put out a report where they state that the high level and structural nature of inequality in our world today represents a systemic risk that poses an existential threat to our society and economy. Next slide, please. So this slide might be more familiar to you just in terms of the terrain that Majority Action has typically been on. We want to emphasize that while inequality is an incredibly important and encompassing frame in North America, we cannot lose sight of the fact that systemic racism is a foundational driver of inequality. Next slide, please. And this may seem self-evident, but I think it's just worth sort of thinking through together. I think one of the best ways to kind of, so first, what I'll say is that historically, the United States economy was built on the appropriation of physical, financial, labor, and other resources of non-white people. And this includes, as Whitney alluded to earlier, the enslavement of Black people, the dispossession of indigenous nations, the exploitation of Asian and Latino migrants, the imperial conquest of Native Hawaiians and Pacific Islander communities. And it's this very violent history and its violent afterlife that renders inequality a foundational driver. Renders racial systemic racism a foundational driver of inequality. Racism, because of this history, leads to the uneven distribution of power, resources, capital, and opportunity in the United States. And I think one of the best ways to look at this and to understand this is through a concrete example, which is what this image alludes to. So I want us to think a little bit about who are the workers who are excluded from the National Labor Relations Act. When the National Labor Relations Act was passed in 1935, domestic workers and agricultural workers were deliberately excluded from coverage. And that's because these jobs at the time were primarily performed by Black workers in the post-slavery South. And neither white owners of capital nor white workers wanted to extend these protections to Black workers. So domestic work and farm work have always been among some of the most dangerous, low-paying, and exploitative jobs. And yet these workers to this day do not have workplace safety protections or collective bargaining rights in many states. And it's no surprise that the majority of these jobs in today's labor market and in today's economy are primarily done by undocumented and immigrant workers. So I think this is like one example of the ways in which the long tail of slavery intersects with other forms of racially inequitable social structures and economic structures to kind of create the levels of labor market inequality that we see today in the United States. Next slide. These graphs will be very familiar to most of you. I think the kind of best way to illustrate the compounding effects of systemic racism are the racial wealth gap. In 2016, and this was nearly 10 years ago, as we'll talk about later, the figures are even more extreme now. But in 2016, the typical white family had about 10 times the wealth of a typical Black family. And that number was 7 times for the typical Hispanic family. So you can see the ways in which communities of color have not been able to make, especially in the past 20 years, where economic policy has largely been driven by deregulation, the systematic decimation of unions, globalization. communities of color have not made substantial gains. Next slide, please. So I want to talk here a little bit about the relationship between systemic and systematic risk. And we want to contend here at Majority Action that systemic racism can and has historically contributed to economic and financial crises that have harmed investors. And the classic example of this is the subprime mortgage crisis, which led to the Great Recession. So in this particular case, racist practices in the post-war era, such as redlining, restrictive racial covenants, and other forms of housing discrimination. So you can see here, these are the background here is one of the kind of classic redlining maps that were produced in cities all throughout the country in the post-war period. So these discriminatory practices effectively locked Black people out of homeownership and rendered them uncreditworthy in the eyes of financial institutions. And this in turn made them prime targets for predatory subprime lending in the 2000s. So subprime loans were first marketed to Black borrowers who could not access prime credit. And then this practice, subprime lending, was then exported to the broader housing market, repackaged into mortgage-backed securities, and sold and traded on Wall Street. And the bubble, when it first burst in Black and brown communities before spilling over into the broader economy and financial system, eventually leading to cascading failures and losses. We're all familiar with that story. But systemic racism also meant that in the aftermath of that crisis, big banks were bailed out, but poor people, people of color, were not bailed out. Many Black people lost their homes and wealth. And they were not given any forms of redress. This in turn made these same communities fertile ground for the next wave of predatory financial instruments, such as payday loans or subprime auto loans, which reintroduced systemic risk into the economy. So this cycle is like really brilliantly described by business law professor Carrie Martin Shelby in this article that's cited here. And she argues, she kind of walks us through this history, walks us through the logic, and argues that racism should, in fact, be classified as a threat to financial stability. Next slide. Okay, so that's like going to be like a pretty front of mind example for many folks, but I want to give another example. And this has to do with the 2013 Detroit bankruptcy. So that bankruptcy, what drove the city of Detroit to declare bankruptcy? This was the largest municipal bankruptcy in history. The bankruptcy was driven in large part by loss of city revenue, tax revenue, and a shrinking tax base. In the last half century, more than 1.5 million white people left Detroit. And a lot of that was catalyzed by racist federal housing policies that subsidized home ownership for white people in racially segregated suburbs while systematically disinvesting in urban centers. White flight essentially left Detroit a primarily poor, overwhelmingly Black city. Now, the bankruptcy itself was absolutely devastating for workers, retirees, and residents, most of whom were Black. But it also affected the fixed income market, and it also affected investors. After the city declared bankruptcy, bondholders who held Detroit debt ultimately received on average only 64 cents on the dollar, and some bondholders received as little as 15% of their claims. The other element here is that because of systemic racism, cities like Detroit with predominantly Black and brown populations pay higher interest rates on municipal bonds than majority white cities. So this in turn contributes to the cycle of debt, poor infrastructure, and overall disinvestment in Black communities, which in turn increases the chance of bankruptcy or default, and that in turn puts bondholders at risk. So this is another example of the ways in which systemic racism can acutely impact investors and the market more broadly. Next slide. So this might seem obvious, but it's worth noting that corporations are a major contributor to inequality and systemic racism. How do they contribute to inequality and systemic racism? In many ways. We don't have time to go through all of the different ways today, but just to name a few: rent seeking in the form of corporate political influence, discriminatory and inequitable workplace practices, tax evasion, business practices that privilege short-term profits over worker health and safety. Again, to quote Carrie Martin Shelby, she describes this relationship, I think, really well. She notes that racist policies and practices, quote, transform communities of color into the ideal dumping grounds for the private sector's negative externalities. And I think that's a really useful frame to think about this. Next slide. So where does all of that leave us? Well, first, inequality and systemic racism pose systematic, unhedgeable risks to the portfolios of long-term diversified investors who don't have easy options for exit. And these risks can be mitigated in part by addressing maladaptive corporate behavior through investment practices, including stewardship, proxy voting, and active ownership. Now, inequality is like, while people have done a lot to socialize the concept of inequality as a systemic risk in the investment community, it's still not widely accepted as, say, the systemic risks related to climate change or biodiversity. But under the leadership of the Task Force on Inequality and Social Related Financial Disclosures, Oxfam and others, investors are starting to build out the infrastructure that we need to be able to assess the costs, dependencies, and risks associated with inequality, to quantify corporate contributions to inequality, and to identify concrete ways in which investors can use stewardship to hold issuers accountable. So there's a lot of momentum here. Next slide, please. And I'll just note that there's a lot of momentum at the right time, because the risks associated with inequality and systemic racism are really more salient than ever. This chart just shows you that income and wealth inequality are increasing in America and have been increasing since the 1980s. Next slide. Likewise, the racial wealth gap has been deepening over the past several years, particularly in the post-pandemic years. So just in terms of overall trends and the level of inequality and the level of systemic racism, we're seeing we're just seeing levels of these things that we haven't seen before in America. Next slide. Third, there's a growing corporate retrenchment around DEI, around labor issues, and increasing legal, political, and regulatory capture by business interests. So Whitney alluded to this. We're seeing a lot of companies pull back on DEI policies. We are seeing companies take a more aggressive stance towards regulation more broadly. Companies such as Amazon, SpaceX, Trader Joe's, Starbucks have all filed lawsuits challenging the constitutionality of the National Labor Relations Board. We've seen business interests challenge the constitutionality of agencies such as the Consumer Finance Protection Bureau, which were set up in part to address the extreme inequities and inequalities that led to the financial crisis. But my point here more broadly is that we are in a period where we're seeing broad corporate retrenchment as well as aggression. Next slide, please. And then on the part of government, we're also seeing growing retrenchment, and we're seeing the dismantling of the administrative state. Whitney talked us through some of these developments already, but I just want to note that under the new administration and leadership, we are seeing agencies like the FTC, the EEOC, the NLRB, OSHA, the EPA, agencies that exist to protect and safeguard the rights of workers, consumers, and communities be systematically dismantled and disinvested in. Next slide. So what does that mean? So if the administrative state, the political systems, the legal systems are not working for us, we have to admit and acknowledge that investors have a crucial role to play here. There's a scholar that calls investors regulators of last resort, in part because of the role that they play in checking and engaging corporations. And increasingly, I think as our legal, political, and regulatory systems are no longer working for us, we need to turn to and embrace the power that investors have, particularly through stewardship, to mitigate the risks related to inequality and systemic racism. Next slide, please. Okay, so that's our introduction, that's our context. So now let's actually get into equity in the boardroom, the data. So let's go to the next slide. I'm going to talk a little bit about scope. So you all will be familiar that in previous years, equity in the boardroom has included a real long list of investors. We did not do that this year for the actual report. This year's report focuses on just the big four asset managers. State Street, Vanguard, BlackRock, and Fidelity. And we also include Geode because of its role as a massive index fund manager. But when we refer to the big four, we're actually referring to these five asset managers. So that's the asset manager universe. This year we looked at 5 categories of shareholder proposals, and we identified these proposals as focusing on issues that are key to mitigating inequality and systemic racism. So those categories were freedom of association, workplace safety, workplace racial and gender equity, the future of work, particularly in relation to artificial intelligence and the carbon transition, and corporate political transparency. I just want to note that like all of these categories are categories that are listed by the Business Commission to tackle inequality as ways in which businesses both areas in which businesses can actively intervene to promote equity and equality. So overall, I'll also say that we did not look at every freedom of association proposal. We did not look at every lobbying proposal. We screened for proposals that received a minimum of 20% support and a positive recommendation from ISS or Glass Lewis. And our reason for doing that is we really wanted to focus on proposals that had broad support in the mainstream investing community. So in all, overall, our universe of proposals included 73 shareholder proposals that were filed at 60 companies. And these companies included S&P 500 companies as well as Russell 3000 companies. Next slide. Okay, so now let's actually get into the data. Next slide, please. I'm going to walk us through these sections pretty quickly because they are quite explanatory, self-explanatory, and I want to give you a chance to actually look at the data when the report comes out. But these two charts look at how the big four asset managers voted on freedom of association proposals and workplace safety proposals. And what's interesting about both categories of proposals is that these proposals were all exclusively filed at issuers where there have been serious concerns around employer interference in union organizing or worker organizing, and in the case of Amazon and Chipotle, where there have been repeated and instances and evidence and investigations around workplace safety hazards and poor oversight of workplace safety issues. Many of these proposals were filed by labor and labor adjacent groups who work very closely with workers and other employer stakeholders. So as you can see here, overwhelmingly, the big four were not supportive of either of these categories of proposals, though State Street was the most supportive of the big four. And this is a trend that you'll see throughout the data. Next slide, please. The next slide looks at proposals that focus on racial and gender equity in the workplace. One thing I'll just note is that despite all of the backlash against diversity, equity, and inclusion, the attacks that we're seeing on civil rights and affirmative action, this continues to be a priority for investors. There were a number of proposals focused on racial and gender equity this past proxy season, and they all did reasonably well. So the 4 kind of subcategories of proposals that we looked at that all had similar, each of these subcategories includes proposals that all had similar resolved clauses. were proposals that asked companies to examine the effectiveness of DEI in hiring, promotion, and retention. Two proposals filed at Tesla and Wells Fargo, both companies that have been embroiled in controversies in recent years around racial discrimination, around their harassment and discrimination prevention efforts. A number of proposals on pay equity, and one proposal at Pepsi that asked the company to conduct a racial equity audit. And I think there's a lot of ways to like slice and dice this data, but I think the overall point we want to communicate to you here is that by far Fidelity and Fidelity's funds were leaders in this space. They tended to vote for more of these proposals than any other Big Four asset manager, closely followed by State Street. Next slide, please. The last set of proposals we looked at were corporate political transparency proposals. These proposals felt very important to look at, given not just the fact that 2024 was an election year, but also looking forward, the undue influence that corporations have under the current administration. So we looked at political spending proposals, which were primarily targeted at companies that underperform their peers on voluntary political spending disclosure. And you can see in political spending that asset managers were more willing to support political spending proposals than they were to support lobbying proposals. In particular, again, Fidelity and State Street really stood out as leaders here. What we did find is that the Big Four asset managers, with the exception of State Street, largely did not support lobbying proposals. And we find this incredibly concerning because the lobbying, the kind of current regime around mandatory lobbying disclosure is very, very fragmented and is not comprehensive. And only 2% of S&P 500 companies currently do any kind of comprehensive lobbying disclosure that includes indirect, direct, and grassroots lobbying. So this is an area that we feel like needs to move, and particularly in this current political moment. Next slide, please. Okay, so this last slide just summarizes all the data for you, hopefully in a way that's a little bit more digestible. It looks at the average level of support for shareholder proposals across each of these categories. The main kind of trends here are that Vanguard continues its streak of supporting 0% of all racial equity and inequality related proposals. This has been the case for years and actually decades. We see massive backsliding by BlackRock. Geode does not have a particularly great record here either. By far, State Street and Fidelity are the Big Four asset managers that really stand out. Okay, next slide, please. Okay. The next section really looks at the proxy voting of the Big Four sustainable funds. And I'll talk about that in a second. Next slide. Okay, so here what we did is we looked at how sustainable funds, so these are funds that have names like ESG, social, impact, responsible in their fund name, how these funds voted on the proposals in our universe. And you might be asking, well, why are you even focused on sustainable funds? This is such a small portion of AUM, particularly in the United States, and that's true. But part of the reason we looked at this is that one of the major things that we hear from the big asset managers is that they are really focused on giving customizable solutions to their clients. They want to follow their clients' mandates. And that's often cited as a reason for why they do not take more ambitious stewardship positions. Well, sustainable funds are interesting because in this case, investors have clearly expressed an interest in sustainable investment objectives. And so this is an opportunity to see how is it that asset managers actually approach this mandate when they are given the mandate. And you can see that they don't really particularly approach it. In the case of BlackRock, Geode, and Vanguard, the vast majority of sustainable funds did not vote for the proposals in our universe, the numbers are slightly better for Fidelity and for State Street. And I will just note that in the US, BlackRock and Vanguard dominate the sustainable passive fund market. The biggest funds are run by BlackRock and Vanguard, and the fastest growing fund is managed by Fidelity. Next slide, please. So this slide looks at, it compares the voting performance of big four sustainable funds to their conventional funds. So funds that do not have ESG or related terms in their fund name. And you can see that in many cases, big four sustainable funds actually underperform their conventional fund counterparts. So there's lots of questions to be asked there around just how the big four are approaching stewardship. Next slide, please. Okay, so the last section of equity in the boardroom this year looks at the proxy voting performance of the largest public pension funds in relation to their asset managers. Next slide. And specifically, we looked at, so here's the kind of universe of investors that we looked at for this section. We looked at the 9 largest public pension funds. We wanted to do the top 10, but the 10th largest fund, North Carolina, does not make their proxy voting data public. So it ended up being the top 9. And we compared their proxy voting performance to the proxy voting performance of BlackRock and State Street, who are the largest managers of US defined benefit assets. 7 out of 9 of these pension funds contract with BlackRock, and 4 out of 9 contract with State Street. They're not always contracting with BlackRock and State Street for public equities management. Sometimes they're contracting for other services, but nonetheless, there is a client relationship. Next slide, please. So this kind of unwieldy chart shows you the average level of support for equity-related shareholder proposals. And it looks at and it really kind of illustrates the divergence between State Street and BlackRock and the largest public pension funds. You'll notice that there's a kind of difference within the asset owners here. Both the Florida SBA as well as the Texas Teachers Fund tend to have lower support for social proposals more broadly and for the proposals in our universe relative to the other pension funds. And that is because of anti-ESG policies that have been passed in those states. Many of you are likely aware of the fact that the Florida SBA was part of a lawsuit against, has filed a lawsuit against Target for its DEI initiatives. And nonetheless, what we find is there's not just a divergence between BlackRock and State Street and what some might call blue state pension funds, but there's even a divergence between BlackRock and State Street and the Florida SBA and the TRS. We find that the Texas teachers voted overwhelmingly for corporate political transparency proposals, while BlackRock and State Street did not. And we find that with the exception of racial and gender equity proposals, the Florida SBA tended to be supportive of inequality-related proposals, including proposals on lobbying, political spending, freedom of association, worker safety, and to some extent, future of work. And that is not mirrored in the voting performance of BlackRock or State Street. Okay, next slide, please. Okay, so this is, so I'm going to quickly walk you through recommendations. I am not our investor engagement specialist, so I'm going to walk you through kind of the high top lines and then invite you to get in touch with our investor engagement team to learn more about our recommendations. Next slide. Okay, so broadly, these are going to be very familiar to many of you. For asset managers and asset owners, we encourage you to be an asset owner. That includes acknowledging the materiality of inequality and systemic racism in important documents, including in your proxy voting policies. It includes setting issuer expectations, engaging issuers around those expectations, amplifying key votes, and adopting and utilizing an escalation pathway when necessary. Another thing that we really want to highlight is for asset managers and asset owners not to backslide on pre-existing commitments that they have made in proxy voting guidelines around things like board diversity or pay equity. For asset owners, we want to encourage you to be an active client. That includes establishing performance expectations for your service providers, including for your asset managers, incorporating performance expectations into search and selection criteria, communicating about proxy voting with your service providers, and reviewing their performance and following through on accountability measures. Next slide, please. Okay, so this link will take you to kind of the slew of resources we have around equity in the boardroom this year. We will currently on our website, we have the executive summary of our report up. Early next week, we will have the full report up that you could read. We also have a stewardship checklist for investors that you can use that build on the recommendations that I just laid out. And then this year, we have also built out an online dashboard. And I'm going to walk folks through the online dashboard right now. Next slide. So as I noted at the very beginning of this presentation, equity in the boardroom has historically focused on the top 20 or 25 asset managers. This year, the report itself only focuses on the big four. But what we've done is developed an online dashboard, an interactive interface where you can still see the voting records of the 22 largest asset managers. And you could see how they voted on the shareholder proposals that we examine in our report. So the purpose of the online dashboard, which includes two separate dashboards, is one, to compare the voting performance of various asset managers. That's what this particular dashboard that I screenshotted for you does. And then the second is to analyze how individual asset managers voted on key categories and proposals. Next slide, please. So this is the second of the two dashboards that's up on the Majority Action website. And so this dashboard actually allows you to select by asset manager, select by proposal category, and to see how the asset manager in question voted on different proposals. So it gives you a level of granularity. Okay, next slide, please. Great. So I have talked a lot. So I'm gonna hand it over to Whitney to kind of facilitate Q&A. Again, if you have any questions, please drop them in the Q&A, and we will try to get to all of them. If we don't get to them, we will get back to you by email.
Thanks so much, Divya. Yeah, so we have a few time for maybe a couple of questions here. So I will pull from some of the ones that we've received and kick them to you to field and have a little dialogue up here. So this first question we received is, so why should pension funds care about how their asset managers vote when most pension funds can vote their own shares via vote choice?
Okay, so that's a really great question. So just to backtrack and make sure we're all on the same page, the largest asset managers have all rolled out vote choice options that essentially allow investors, now increasingly retail investors, but it started with institutional investors, to be able to vote their own shares as opposed to relying on the asset manager to vote their shares. That is also something that pension funds and other institutional investors with separately managed accounts have always been able to do. So the question is really okay, I can vote my own shares and I can vote them the way I want to. So why do I need to engage my asset manager? Why do I care what BlackRock or State Street are doing? And our contention here is that vote choice, while it's important and valuable, does not obviate the impact of the big four's stewardship practices, particularly the impact of BlackRock and State Street stewardship practices on pension portfolios. And we'll note that at the same time, it's not a coincidence that at the same time that BlackRock, State Street, and others have unveiled voting choice options and are expanding voting choice options, they've also really drastically scaled back their stewardship ambitions. There have been, any number of reports by Morningstar and others showing declining support for E&S proposals over the past several years. Um, and the crucial point here also is that the largest asset managers still vote the vast majority of shares that they manage, even though they are making a big deal about vote choice. Um, Clients, I think, clients of BlackRock, uh, who are using vote choice, only account for about 5% of BlackRock's equities AUM. So it's a very, very small percentage. So what that means is that regardless of whether you as a pension fund or an asset owner are using vote choice, uh, your ability to meet, well, particularly the ability of pensions to meet their long-term obligations, um, remain subject to the macroeconomic consequences of asset managers, uh, and how they use their outsized proxy voting power to mitigate systemic risks. So for this reason, we still encourage long-term investors, particularly pension fund clients, to utilize vote choice options, but continue to engage their asset managers on their proxy voting policies. It still materially impacts them, and it still materially impacts their portfolios.
Thank you so much, Divya. Let's go into the next question. Let's go with this one. So given that a number of companies have rolled back their DEI commitments, what can investors do to prioritize their stewardship values? And what can investors ask issuers in this moment to do given the current environment?
Yeah, I mean, that's a good question, and it can often feel like quite, daunting. This is like a very difficult and challenging environment right now. I think one thing I would recommend is, or one thing I would note is that just a few years ago, the same companies that are rolling back their DEI commitments now, so Walmart, for example, is a great example. Walmart years ago was touting the positive impacts of DEI and citing studies, claiming that DEI would actually help their financial performance, and minimize operational and human capital risks. Um, I don't think it's wrong to say that many of the rollbacks of corporate DEI commitments we've seen have not been accompanied with robust explanations for the material basis of those rollbacks. It largely seems to be a response to the current political climate and to pressures, external political pressures. So I would really encourage investors to engage as issuers and ask them difficult questions about what the material basis of the rollbacks are. And on the flip side, to continue to ensure that that what corporations may or may not be calling DEI, actually do materially improve conditions for workers, and lead to kind of better operational resilience and minimizing of human capital risks. So I think it cuts both ways. The other thing we'll just note is that, and we alluded to this in our recommendations, is that engaging issuers is really important, but at some point, engagement really taps out. We've heard this from a number of investors that we work with. And so we also want to encourage people to continue to invest in forceful stewardship. That includes using other types of accountability measures, moving beyond engagement to filing or voting for shareholder proposals, to vote against directors, which is we're seeing increasingly on the climate side, and publicly and privately communicating vote rationales to corporate boards. Whitney, is there anything you want to add?
No, I mean, that was such a helpful breakdown, Divya. I think, just kind of as we tie a bow on your remarks on the report, on Majority Action's take, again, continuing to hold the line around what we know to be true, that, inequality, systemic racism are systemic risks. And so we have well within our rights to be bringing this up as for concern and for immediate action as well. And so just, yeah, really, really fitting our strategies to that moment, depoliticizing ideas around human rights, these ideas that are, non-negotiables, really just holding the line there. So yeah, thank you again, Divya, really for the incredible labor that has gone into this report. I think it's so important for these kinds of things to exist in the world and for people to continue to gather here. And so if I think we might have to move to close unless Divya had any other kind of remarks or comments before we do that. And thanks. I think yeah, some of the other questions that we received around logistics or when things will be shared, please expect, yeah, follow-up emails from us at the top of next week with the full report that will be live by then, along with the resources that we shared here and the slide deck included. And please continue to reach out with us, engage with us, continue to think with us in these times around what's needed. But yeah, thank you again so much, Divya. If we want to move to our next slide, and I'll close us out here with a couple more resources that Majority has on deck for you all. So as we know, equity in the boardroom, and we also have our flagship report, Climate in the Boardroom, which was released several weeks ago, which is live on our website. Those are retrospective analyses of previous proxy season, and then we hope that it helps gear up and get folks geared up for 2025 proxy season. And that those resources that we want to share with you all are our vote guides, which include our recommendations and analysis to help those who are casting votes against a range of shareholder proposals and director votes and others aligned that really help mitigate the risks related to inequality and systemic racism. So that guide is live on our website. We have a climate guide that will accompany our equity in the boardroom vote guide accompanies the same categories that Divya just covered in the retrospective. And we also will have a climate vote guide for folks to reference in the coming days as well. So please check back on our website for both of those awesome resources that you can utilize that may help you yeah, navigate it and address systemic risks through proxy voting. And yeah, we're really excited to share those vote guides with you all and those resources, and hope you will be in touch with any questions that you have on those as well. So those are on our website at this the link above. And yeah, is there another slide after that? I think that's where we're closing out. So yeah, lots moving in the 2025 proxy season. Yes, again, we are here to support. It's so helpful to hear what data gaps you're missing as you make your case, as you hold this line, as you know, become an active owner or continue to be active owners and active clients. So really, again, we and many of the partners that we mentioned in this presentation as well, I think are ready and willing to continue to hold the line together. So with that, I think that closes our webinar for today. Thank you again, everyone, for joining us. Slew of resources will be available to you all soon in a follow-up email. And again, just thank you for all the work that you're doing, for continuing to be conscious and aware of what we are moving through, and yeah, for all that you're bringing to our better tomorrow. So thank you all, and we'll talk soon, hopefully.